Well, choosing between a 25-year and a 30-year mortgage can seem like a massive decision if you are looking at picking a mortgage, and it can seem like a massively daunting one when you consider the potential ramifications of the interest and scary things that your family might have told you about the different amortizations. But listen, there's pros and cons in every one of these situations, and in today's video, we're going to explore the benefits and disadvantages of taking a shorter versus a longer amortization. So stay tuned to the video, and if you like it, at the end, I'm going to ask you to hit that freaking like button and leave a comment below with any questions that you have. We'll see you on the other side. Hey everybody, welcome back to the channel. I'm Alex McFadyen, your resident mortgage expert. I focus on real estate, wealth, and basically everything that's having to do with money and mortgages in our country of Canada. In today's conversation, we're going to talk about amortizations, 25 versus 30 years. It's actually been a topic that's come up a lot in the last couple of years, specifically as interest rates have increased, putting a lot more pressure on the ability for people to qualify and also the cost of borrowing. So we're going to highlight the pros and the cons of a 25 versus a 30-year amortization, which option that you should choose, how to know which option makes sense for you, and more importantly, really a full breakdown on what you should know and what you should consider. So let's get right into it. So first off, let's break down amortization in its entirety. Amortization is the length of time of which you have to pay off a loan. In Canada, unlike in the United States, where a lot of people seem to get their information these days, we typically only do term lengths of 1, 2, 3, 4, 5, 7, and 10 years, which means typically speaking, you could take a fixed or a variable rate mortgage for up to a maximum of 10 years, but the average is 5 years or less. But you have the ability to choose to amortize your loan, which means the length of time at which the payments can be made over 25 or 30 years. But here's the crazy thing, because your term is only 1, 2, 3, 4, 5 years, you have the choice every single time that your mortgage hits the end of its term to choose if you want to continue on your same amortization or reset the amortization. We'll talk about that a little bit later. And let's talk about a few basics and get them out of the way. If you're buying a home through CMHC insurance, which basically means you're buying a home with less than 20% down or using one of the insurance-based programs, unless it's a brand new property and you're a first-time buyer, you can only do 25 years. So we'll get that out of the way right now. Back in 2012, we used to be able to do 30 years under the CMHC insured program. They got rid of that. Now it's 25 years maximum if you have less than 20% down. One exception to that, in 2024, in August, the government of Canada introduced some new rules around first-time buyers who are buying with less than 20% down, where if it is a new property, if you're following me here, first-time buyer, new property, less than 20% down, they have the option of a 30-year amortization with a slightly higher insurance cost. Let's get back on track because you're focused on 25 versus 30 years. Starting off with the 25-year amortization, if we just wanted to kind of look through the potential pros and cons of a 25-year amortization right away, if you're paying it off over 25 years as opposed to 30 years, you're paying it faster, which means less interest cost right away. We're going to talk about how you could still get that with a 30-year, but we're going to touch on that at a later time. So less interest costs, you pay less interest over 25 years than you do 30 years because you're extending the timeline shorter. Straight and simple. I think most people understand that concept. The second one is because you're paying it off over 25 years, you're essentially just paying a higher monthly payment than a 30-year, which means you essentially build up more forced equity faster. You're paying off the mortgage faster, you're paying off more principal. You'll have more equity in your property, which means technically speaking, you can draw more equity, or if you sell it, you could use that equity to buy something else or leverage up, or you could access the equity for a home equity line of credit. Either way, with a 25-year, you get more equity quicker. Some of the cons on the 25-year amortization right away, number one, would be, well, you have to make a larger payment than you would on a 30-year amortization. So you're paying it off faster, but you're also making a higher payment and you're confined to that 25-year payment. You can't just drop back to 30 years without refinancing the mortgage. The other con to consider is that you would have less flexibility in your budget in terms of what you can do from a cash flow perspective because of the fact that it is a 25-year versus a 30-year on a monthly payment. Now, in these examples that I'm going to give you later on, I'm also assuming that someone has the ability to put 20% down and qualify for a 20 or a 30-year amortization, or they fit in that other box. But either way, let's assume you have the ability to qualify for 25 to 30 years. There's a few things that you need to know, so let's lay a little bit of groundwork. First and foremost, if you take a 30-year amortization, you will actually qualify for a larger amount of money. And this is because most banks, if you're taking a payment over 30 years, they will qualify you for a payment over 30 years. There are a few exceptions. Some lenders require you to qualify over 25 years, specifically if you're looking to get a home equity line of credit. But if you're just qualifying for a conventional or a typical mortgage, this will allow you to borrow more money. How much more? About 12 to 15%, depending on how that lender qualifies you. So that could be a significant amount of money, all things considered, if you're looking at your options when you're qualifying. Now, let's look at a few of the pros on the 30-year amortization, and then we're going to talk a little bit about the cost difference. One of the pros right away of the 30-year amortization is a lower monthly payment and lower obligation. And this is key for a variety of reasons. So first and foremost, a lower monthly payment means you have more cash in your pocket. So if you want to spend more of your money on the lifestyle or expenditures or anything you want, you've got more money. Number two, it gives you the ability to invest that money. Let's say you have the ability to pay it off over 25 years, yet you prefer to invest your money into different items such as the stock market. Maybe you want to put it into more real estate. Maybe you want to invest into your business. Whatever that might be, that 25-year amortization means you have to pay it off and your payments are higher. The 30-year one gives you the flexibility to have a higher amount of cash flow, which is pretty key, and it allows you to invest your money. Some people are great at investing and they can earn a greater rate of return than the cost of borrowing. This is a key consideration. Ultimately, this provides for a greater amount of flexibility as well, especially as it pertains to items like qualification. If you have a 30-year amortization and you're someone who invests in real estate, this gives you the ability to actually qualify for a larger mortgage on the next property, which is massive when you're considering utilizing multiple mortgages to purchase multiple pieces of real estate, especially if you want to leverage the maximum amount from that property that you're looking at buying right now. So it's cash flow, it's the minimum payments for flexibility, it provides you the ability to invest your money elsewhere, and then last but not least, the ability to leverage additional assets or even qualify for more on that property. What are the cons of a 30-year amortization? Is exactly the opposite of what we talked about. One of the cons is that if you take a 30-year, you're paying more interest. You're paying more interest over the lifetime of the overall mortgage. In this example, on a $500,000 mortgage borrowed at 5.15%, you would pay $515,000 of interest over 30 years, and over 25 years, it would be about $415,000 of interest. But the key to that is that you have to remember a few things. Number one, just because you take a 30-year amortization doesn't mean you have to take 30 years to pay it off. In fact, if you did a 30-year amortization and then you earned a substantial amount more money and you wanted to, well, let's say increase your monthly payments, the 30-year amortization means that you can simply, if you have the flexibility, if you have the prepayments, you can add more money monthly, or you can do lump sum payments if your lender allows for that, which means you can actually pay it off even faster. It just gives you that flexibility. The second thing is some of our clients take the 30-year amortization earlier in their house ownership days, and then as they earn more money, they reduce their amortization, therein paying it off faster because their budget and their lifestyle has changed and adapted to that higher amount of money. So there's different ways that you can look at it, and there's a variety of pros and cons. One thing that you should know if you're taking a 25 versus a 30-year amortization is there is a slight difference in cost. Now, your conventional lenders and banks typically price a 30-year amortized mortgage about 0.1 to 0.2% higher than a standard mortgage product. There are some unique circumstances where that spread or the amount between the 25 to the 30 year could be even greater than that, but that is kind of a standard that you see across the board for most banks and lenders. So what would a monthly payment difference be at that same example? 5.5%, $500,000. You're looking at 25-year versus 30-year. We're going to use the same interest rate with a 25-year amortization. As of today, your payments are $3,051. With a 30-year, you're looking at $2,819. So not a massive payment, but over $200 a month that can go towards a variety of other considerations. And for a lot of families, it's a significant amount of money. I mean, for a lot of people, that's a significant amount of money. It could be multiple gas tanks. It could be a couple of grocery bills. It could be money that you're investing into something for your future. There is no way to deny it. There is a difference when you factor in that 25 versus 30-year amortization period, and it has a big impact on how people do things. Now, one thing that's been left unsaid as far as the pros of the 30-year amortization has been the fact that there's kind of like an emergency backup plan. A lot of our clients will take the 30-year and then they will increase their monthly payments to pay it off faster. And if something were to happen from an emergency perspective, which we have seen this happen before, whether it be death, sickness, maybe someone has a child or gets pregnant and their income is lowered. In any of of these circumstances, you can lower your payments back to the 30-year amortization to give yourself a little bit more flexibility from a budget perspective. So there you have it. Those are many of the differences between a 25-year and a 30-year amortization that you should be aware of if you're making a decision. Which one would you choose if you were getting a mortgage today? Did any of those things help you? Please let me know in the comments below. And if you like the video, hit the like button and subscribe for the next one.